Why do some stocks go stratospheric while others, barely budge?
Hmm.
You might think it's all about market hype, but what if the real secret lies in something uh, far more fundamental?
Like what exactly?
How we actually tally up a company's worth, and maybe whether we recognize that their cash on hand is just as crucial as, say, their physical factories.
Okay, so getting down to the building blocks.
Exactly. Believe it or not, some groundbreaking new research suggests that getting these seemingly basic details right, well, it dramatically boosts our ability to understand and maybe even anticipate stock market winners.
Okay, that sounds significant. We should definitely unpack that.
Yeah, let's do it. What's fascinating here is this idea that the way we zoom out, from individual companies to look at the broader,
Big aggregation part.
right, the aggregation, and also whether we recognize that a company invests in different kinds of assets.
What they call capital heterogeneity.
Yeah, that these things have a surprisingly huge impact on how well our financial models actually work.
It really makes you question some of the maybe overly simplistic ways we often try to understand market behavior, doesn't it?
It absolutely does. And that's precisely the rabbit hole we're diving into today. We're exploring a really illuminating research paper.
Okay.
It's titled Aggregation, Capital Heterogeneity, and the Investment CAPM. The authors are Andreas Gonçalves, Chen Xu, and Lu Zhang.
Right, and Lu Zhang has done a lot of work on the investment CAPM.
Exactly. Now, you flagged this paper for us, knowing our shared quest, maybe, to cut through the jargon and grasp the core truths in complex info.
Always trying.
So consider this your fast track to understanding a pretty significant leap forward in how we model stock returns.
And I think, connecting this to the bigger picture
Yeah.
for anyone trying to really get a handle on investment strategies or even just understand the fundamental forces playing out in the market,
Yeah.
this research offers a richer and, as we're about to see, probably a far more accurate perspective.
It moves us beyond some of the more basic models, maybe.
Definitely. Moves beyond the simpler and, frankly, sometimes less effective ways of looking at things.
So our mission today, which we've enthusiastically accepted,
Always.
is to unravel how these complexities, aggregation, so how we combine financial data and capital heterogeneity, recognizing that a company's investments aren't all just one thing.
Right, different buckets.
How these things sharpen our understanding of why some stocks
Yeah.
generate higher returns than others.
Okay.
The paper itself, it's a serious piece of academic work published in the Review of Financial Studies,
Yeah.
really gets down to the nitty-gritty of financial economics and asset pricing models.
It does. And, this brings up a crucial question right at the start.
Yeah.
Why has it been such a challenge to properly account for this stuff, for aggregation and heterogeneity in the past?
Good question. Did people not think about it?
Well, the paper actually references some foundational work by a researcher named Nickel way back in 1978. He highlighted 3 major, let's call them headaches, in this area.
Ugh. Ah, yes. Nichols headache trifecta. Okay, tell us more. What was the first one?
First, Nickel questioned whether we can even create meaningful aggregate measures for things like, say, a company's output, its machinery, its workforce, in a way that still lets us define a useful overall production function. Basically, can we just add up everything from a bunch of different companies and expect it to behave like one giant single entity?
And his conclusion.
Generally, no. At least not in most, realistic scenarios.
Yeah, it makes intuitive sense, right?
Yeah.
You can't really treat a massive, sprawling corporation the same way you'd treat a nimble startup, even if their total assets happen to be similar.
Exactly. They operate under completely different dynamics.
Okay, so that's headache number 1. What was the second?
Second, even if our mathematical descriptions of individual companies are, let's say, reasonably accurate, it becomes really tricky to apply the same theoretical rules and restrictions when we look at these aggregated relationships. Well, if the underlying connections at the firm level are intricate, or maybe they don't follow simple straight lines, those complexities don't just magically disappear when you combine everything.
Right. So the elegant math we use for individual businesses can get messy, maybe even misleading, when we scale up to portfolios or the whole market.
Got it.
And the third challenge Nickel identified.
The third was a very practical problem. How do we actually measure investment in capital stock?
Ah, the data issue.
Exactly. Investment figures, for example, can be based on various events, orders placed, goods delivered, payments made.
And those don't always line up.
Right, they don't necessarily coincide with when an asset truly starts contributing as productive capital. And then there's figuring out the current value of older equipment, especially when there isn't really an active resale market for it. That's a significant hurdle.
So a lot of the raw data we rely on to build these financial models isn't as clean and precise as we might, ideally want it to be.
That's a big part of it. Now, the authors of this paper, they directly tackle the second of Nichols' challenges, the aggregation problem, head on.
Okay.
And they also make significant progress, I'd say, in addressing capital heterogeneity and the measurement issues, particularly within the framework of the investment CAPM.
Right. The investment capital asset pricing model, which, as you said, Lu Zhang has been heavily involved in developing.
Yes.
Now, before this paper, how were researchers typically using the investment CAPM? What was the standard approach that this new work is trying to improve upon?
So traditionally, studies applied the investment CAPM at the portfolio level.
Okay.
Which means taking financial data from individual companies, things like how much they're investing, the size of their assets, and then averaging or summing those figures up first to create portfolio level data.
Right. Get the average investment rate for the portfolio, things like that.
Exactly. And from those combined portfolio variables, they would then calculate investment returns for the entire portfolio and try to see if those returns matched the actual stock market returns of those same portfolios.
Okay. I can see how aggregating early like that would simplify the math, maybe.
Yeah.
But the paper highlights a couple of really significant downsides to doing it that way, doesn't it?
Yes, two really critical drawbacks. First, from an economic standpoint, it essentially assumes that every single company within a given portfolio is investing at the exact same rate.
Which seems unlikely.
Yeah, that's a pretty unrealistic assumption when you consider the vast diversity of businesses, even within the same industry, right? Some might be aggressively expanding, pouring money into new projects.
While others are stable, maybe paying dividends.
Precisely. Focusing on efficiency, returning profits, completely different investment profiles.
Definitely. You lose all that rich detail about what individual companies are actually doing. And what was the second major problem with this portfolio level approach?
Well, from a statistical perspective, by aggregating the data right at the beginning, you essentially discard a massive amount of valuable information.
Information that's in the differences between companies.
Exactly. The heterogeneity, the variation between individual companies. This variation can actually be really powerful in helping us pinpoint the fundamental relationships within the model, the core drivers we're trying to understand.
So this paper takes a different route. Instead of combining everything first, what do?
They essentially flip the process. Their innovative approach is to first calculate investment returns for each individual company, using that company's specific financial data.
Okay, firm by firm.
Firm by firm. Only after they've done this calculation for each firm do they then combine these firm-level investment returns up to the portfolio level.
Ah, so they preserve the individual differences for longer.
Exactly. This way, they respect the inherent uniqueness of each business.
That makes a lot of sense. It's like saying, let's understand the characteristics of each individual building before we analyze the skyline of the entire city.
Good analogy.
Now, the title also mentions capital heterogeneity. We've talked about aggregation, but what exactly does this paper mean by recognizing different kinds of capital?
Right. So historically, many of these financial models have treated a company's capital as, one big undifferentiated lump.
Usually physical assets, right? Property, plant, equipment, PP&E.
Exactly, focusing on physical assets like buildings and machinery. But the authors argue that this ignores the fact that companies utilize different types of productive resources. They specifically emphasize working capital as a distinct and crucial component alongside physical capital.
Working capital, okay, remind us. That's things like their cash reserves, money owed by customers, accounts receivable, and their inventory, right? The more sort of liquid assets used day to day.
Exactly that. And they make a compelling argument for why it's essential to consider working capital alongside traditional physical capital.
Why is it so important?
For one, it's absolutely vital for a company's operations. I mean, think about managing everyday expenses, funding short-term needs, keeping the production and sales processes running smoothly.
Right, you need cash to pay salaries, buy raw materials, even if you have a giant factory.
Absolutely. You need that readily available working capital to actually make effective use of those big, tangible physical assets.
Makes sense.
And the authors also highlight a practical reason for focusing on working capital. It's relatively easy to measure using standard information from companies' balance sheets.
Ah, unlike some other things.
Well,
All right.
yeah, they did consider other potential inputs like labor, the skills and knowledge of employees, and intangible assets like brand recognition, patents, things like that.
Sure.
But they ran into significant problems with data availability.
Hmm.
For instance, in their data set, a staggering 80%, 0% of the wage information at the individual company level was missing.
Wow, that's a massive hole.
Huge. And intangible assets are even more notoriously difficult to quantify consistently across different companies and time periods.
Okay, so sticking with something measurable and readily available like working capital makes their analysis much more reliable, more grounded in real-world information.
Exactly.
And is working capital actually a significant portion of a company's total capital? It's not just some minor detail they added in, is it?
Not at all. Their research shows that working capital constitutes a substantial portion of a company's overall capital base.
Really? How substantial?
On average, physical capital only makes up about 38% of the total of physical and working capital combined in their sample.
So working capital is actually the majority on average,
Yeah.
more than 60%.
In their sample, yes, based on that combined measure.
Yeah.
That really underscores how important it is not to overlook this pretty significant component.
Okay, so they've got this innovative approach. Analyze data at the firm level first, then combine it, and also recognize working capital as distinct from physical capital. How do they weave all this together into their model? What's the basic structure look like?
So they develop what they call a two-capital model. They start with a fairly standard framework, the Cobb-Douglas production function.
Okay, I vaguely remember that from econ class. It's like a recipe. Right?
Yeah, think of it as a basic recipe for how a company generates its output, its sales. It shows how the ingredients, in this case physical capital and working capital, combine to produce those sales.
Got it.
Then, from that starting point, they derive mathematical equations for the investment returns of both physical capital and working capital separately.
And what do those equations capture?
Essentially, they balance the added benefit a company gets from investing a bit more in each type of capital against the costs associated with making that investment, marginal benefit versus marginal cost.
Okay, so for physical capital, that cost would include not just the purchase price, but maybe also expenses or disruptions from installing new equipment, adjustment costs.
Exactly. They use a standard way of modeling these extra costs called a quadratic adjustment cost function, specifically for physical capital.
Okay, and for working capital?
Here's a clever simplification. They actually assume there are no such additional adjustment costs for working capital.
Really? Just the cost of acquiring it?
Basically, yes. This makes the model easier to handle mathematically. And importantly, as the results show later, it doesn't seem to significantly compromise the model's accuracy. Just including working capital itself seems to be the key improvement.
Interesting. So what do these investment return equations actually look like? What are the key factors driving them?
Okay, for physical capital, the return depends on how much additional profit that capital generates after taxes.
Marginal product, basically.
Right. As well as changes in those adjustment costs we just talked about, and also the rate at which the capital wears out depreciation.
Makes sense. And the return on working capital.
That one's a bit simpler because they assume no adjustment costs. So it's primarily driven by how much additional after-tax profit it generates its marginal product.
Okay. And from these equations describing the returns on different types of capital, they then derive their version of the investment CAPM, right? The equation that connects these fundamental investment returns to what we should expect from stock market returns.
Yes, exactly. And this is where it gets really interesting. They derive a specific equation, it's equation 5 in the paper, where the expected stock return, which they call the fundamental return, is determined by characteristics of the company itself. Things like the investment returns on its physical and working capital, how much debt it has its leverage, and the relative importance, the value weight, of each type of capital to the company's overall market value.
So it's built from the ground up from the company's operations.
Precisely. And it's really important to understand that this fundamental return is rooted in the underlying economics of the business, not directly in the fluctuating prices you see on the stock market ticker every day.
Okay, so they're building this model where a stock's predicted return is anchored in these core operational and investment decisions of the company itself. That feels like a really powerful underlying concept.
It is. And a key finding here, sort of linked to what we said before, is that even without explicitly modeling those extra adjustment costs for working capital.
Yeah.
Just including working capital in the equation significantly improves the model's ability to explain expected stock returns.
So working capital isn't just passive, it actively influences expected returns.
That's what the results suggest. It seems to influence how investors view a company's risk and therefore its required or expected return.
Okay. Now, how do they actually put this model to the test? How do they see if these theoretically derived fundamental returns actually line up with what we observe in the real-world stock market?
They use a statistical technique called the Generalized Method of Moments, or GMM for short.
Okay, GMM sounds technical.
It is a bit, but think of it as a sophisticated way for us to check if the predictions our model makes tend to match the real-world data, on average, over time.
So does the model's prediction match the actual average return?
Exactly. Specifically, they test whether the average stock return of a group of companies, a portfolio, is equal to the average fundamental return predicted by their model for that same group.
And why focus on the average return?
Well, they point out that a lot of the puzzles, the anomalies in the world of finance, revolve around why certain types of stocks tend to earn higher average returns than others over the long run.
Right, things like the value premium, where stocks that look cheap on certain metrics tend to outperform expensive ones, or the momentum premium, where stocks that have been going up tend to keep going up.
Exactly. Those are all about differences in expected or average returns.
Got it.
And just one more technical point. While their model initially involves 3 underlying parameters related to how companies produce goods and those adjustment costs, they discover that only the combined importance of physical and working capital in generating sales, a combined capital share, can be reliably estimated from the data.
So they simplify it.
Yes, it keeps their 2 capital model relatively simple, or parsimonious, with just 2 key parameters to estimate, which is actually similar to the simpler, older models that only considered physical capital.
Okay, so that makes for a cleaner comparison, right?
Exactly. A more direct and meaningful comparison.
Okay, so they've constructed this 2 capital model, uses individual company data, distinguishes between physical and working capital. Let's get to the payoff. What do their actual findings reveal? Does this more detailed model do a better job explaining why some stocks perform differently than others?
The results are quite compelling, actually. First, they basically replicate or confirm what earlier studies have shown.
Which is?
That if you use a model that only considers physical capital and you combine all the company data at the portfolio level before running the analysis.
The traditional way.
The traditional way. That model really struggles to simultaneously explain well-known market patterns like the value premium and the momentum premium.
It can't explain both at the same time.
Not very well. The parameters of the model even seem to change depending on whether you're trying to explain value stocks or momentum stocks.
Which sounds like a sign the model isn't quite right.
It's a sign that the model isn't capturing something fundamental, yeah. If you need different settings for different phenomena, it's probably missing the underlying connection.
Okay, so that's the baseline. What about their model?
Right, here's the crucial result. Their benchmark 2 capital model, where they analyze each company individually first, it succeeds in explaining both the value and momentum premiums at the same time, with the same model parameters.
Okay, that's big.
It is. They find that the key parameters of their model are much more stable across different groups of stocks, whether you group them by value, momentum, how much they invest, their profitability. The parameters hold steady.
And the errors? The difference between prediction and reality?
Significantly smaller. The errors in their model's predictions, economists call them alphas, are much, much smaller compared to those simpler traditional models.
Wow. That sounds like a major leap forward. Can you give us a sense of just how much better it performs? Can we put a number on that improvement?
Yeah, they provide some numbers. When they jointly test the model on portfolios of stocks sorted by both value and momentum characteristics.
Okay, a tough test.
A very tough test. The average absolute difference between the model's predicted returns and the actual returns for the extreme portfolios, you know, the highest value momentum versus the lowest, that difference, the high minus low alpha.
Yeah.
It's dramatically reduced with their 2 capital firm level approach compared to the traditional physical capital portfolio level approach. We're talking about a reduction from something like 7% per year.
Which is huge in finance.
Huge. Down to less than 1% per year with their model.
Okay, that's not just tweaking. That's a fundamentally better fit to the data.
It's a really substantial increase in how well the model explains what's actually happening.
Wow. Okay, so what's the underlying reason why? Why does this more detailed 2 capital model analyzed at the individual company level, do such a significantly better job capturing these well-known market patterns? What's the intuition?
Well, they dig into this by examining how a company's current investment levels, their expected future investment, and their expected profitability relate to the expected returns predicted by their model.
And what do they find?
For example, their analysis suggests that companies that are currently investing relatively little
Low investment now.
tend to have higher expected returns in the future. And that's consistent with the value premium, right? Value stocks are often seen as those investing less currently.
Okay, that makes sense. What about momentum?
Conversely, companies that are expected to invest heavily in the future also tend to have higher expected returns predicted by the model,
High expected future investment.
which aligns pretty well with the momentum premium. Momentum stocks are often those perceived to have strong future growth and investment prospects.
So it's this dynamic interplay, this tug of war, as they call it, between what a company is doing now with investment and what it's expected to do in the future that helps generate these premiums.
That seems to be the core idea.
Yeah.
Value stocks might be underinvesting currently, but perhaps have potential for future improvement or higher returns given their low valuation. Momentum stocks might be in a high growth phase with significant ongoing and expected investment driving their returns.
Okay.
They do what's called a comparative statics analysis, basically tweaking one factor at a time in the model to see its impact. They find that a company's current level of investment is a major driver of both the value premium and the overall investment premium in their model, while the expected future investment is more influential for explaining the momentum and profitability premiums.
That's fascinating. It links these abstract premiums back to concrete company actions and expectations. Now, what about the impact of their two key innovations specifically? Analyzing at the firm level and including working capital. How much does each of those contribute?
Yeah, they specifically test this. They compare their main model to variations. One where they use their two capital model, but aggregate the data first, at the portfolio level.
Like the old way, but with working capital included.
Right, and another variation where they analyze at the firm level, but only use physical capital, ignoring working capital.
Okay, isolating the effects. What happens?
They find that both aggregating too early and leaving out working capital lead to significantly larger prediction errors, bigger alphas.
So both changes matter.
Both matter. Aggregating at the portfolio level seems to lose those crucial details in the individual company data, making it particularly hard for the model to accurately capture the value premium when tested jointly with momentum.
You lose the firm's specific story.
Exactly. And ignoring working capital means the model has a less accurate picture of how efficiently a company is using its overall assets to generate profits. It mischaracterizes the average product of capital, essentially. And again, that leads to larger discrepancies with actual market returns.
So it's really not just one thing in isolation. It's the combination, the more detailed, company-specific analysis, plus a more complete understanding of the company's capital structure that unlocks this improved ability to explain stock returns.
That's exactly the conclusion, yes. But their analysis doesn't stop at just explaining average returns over long periods.
Oh. What else do they look at?
They also investigate whether their model can provide insights into how these market premiums behave and change over time, the dynamics.
That's really interesting. So can the model, which was calibrated based on average returns, also shed light on why, say, the value premium might be stronger in some years than others, or momentum?
That's the crucial question, right? Does it capture the time variation? And their findings are quite encouraging here.
How so?
They discover that their model can explain some of the patterns we actually observe in how these factor premiums fluctuate across different calendar periods, and even in response to specific economic events.
Even though the model wasn't specifically built to do that.
Exactly. Even though the parameters were only estimated based on long-run average returns. For example, it offers a partial explanation for why momentum and profitability premiums tend to be higher during economic expansions and maybe more short-lived, while value and investment premiums tend to be higher during economic downturns and perhaps more persistent over time.
Wow. That's a pretty strong validation of the model's underlying logic then. It's not just fitting historical averages, it seems to be capturing some of the dynamic behavior of the market as well.
It seems to, yes. And furthermore, they looked at the correlations between the actual stock returns we see in the market and their model's calculated fundamental returns.
Okay, how closely do they move together?
Well, previous research using older models had actually found surprisingly weak or sometimes even negative correlations, which was a bit of a puzzle for existing theories. Why would fundamentals and stock prices move in opposite directions?
Yeah, that seems counterintuitive.
It does. But this paper finds significantly positive correlations, both when looking at individual companies and at portfolios.
So their fundamental return actually tracks market returns better.
It seems to, particularly for the value and investment premiums. The correlations aren't perfect, obviously. The market has lots going on, but they are consistently positive and statistically significant.
So that suggests their model is doing a much better job of capturing the underlying economic forces that are at least partially driving stock prices.
That's the interpretation. The fundamental value their model calculates seems to be moving more in sync with how the market is actually valuing these companies, helping to resolve that previous disconnect or correlation puzzle.
Okay. Correlation dynamics. Anything else?
One more big test,
Oh.
out-of-sample forecasting.
The crystal ball test. Can the model predict the future?
Well, maybe not predict it perfectly, but can its predictions of expected returns actually forecast how stocks will perform subsequently? That's really the ultimate test, isn't it? A model that not only explains the past, but also has some predictive power.
Absolutely. So what did they find?
And they find that it does. Their out-of-sample tests demonstrate that the expected returns generated by their model, when updated periodically with new data, reliably predict subsequent stock returns. Stocks the model says should have higher returns do tend to have higher returns in the following period, on average.
That's impressive. Did they compare it to other models?
Yes, interestingly, they even compare their model to other sophisticated factor models, like the Q-factor model, which also incorporates investment-based ideas, but maybe in a more simplified factor-based way. And they find that their more structurally detailed model, built from the firm level up, actually performs even better at forecasting future returns than the Q-factor model in their tests.
Okay, so bringing this all together then. Yeah. For someone who's been following along with this deep dive, what's the core message, the really important takeaway from all this research?
I think the central takeaway is this. If we really want to understand why some stocks outperform others and make sense of these persistent patterns we see in the market, like value and momentum, we need to move beyond overly simplistic models. Models that treat all companies the same, or all forms of capital as the same lump.
We need more detail.
We need a more detailed approach, one that respects the unique characteristics of individual companies and that acknowledges the different roles of their investments specifically, including both physical assets and working capital. That approach seems to provide a much more accurate and, frankly, more insightful perspective on stock market returns.
So the real aha moment for me is realizing that these seemingly technical details, how we combine data, how we define capital, aren't just technicalities. They have a profoundly significant impact on our understanding of what actually drives investment returns.
Exactly.
It's a powerful reminder, isn't it, that just looking at broad averages, aggregating too soon, can obscure a lot of the important nuanced activity happening beneath the surface at the individual company level.
Absolutely. And this has real implications potentially for how we think about constructing investment strategies, how we assess risk.
And maybe where research goes next.
For sure. And where future research and financial modeling might fruitfully focus. Perhaps paying even closer attention to the dynamics of working capital or other firm-specific investment behaviors could lead to even more refined and effective models down the road.
This really makes you think, though. If these models, the ones incorporating such detailed company-level information, are so much more accurate, why do the simpler, more aggregated models still feature so prominently in financial news and everyday discussions?
It's a great question. Inertia, simplicity, easier data requirements, probably a mix.
And maybe what other aspects of a company's unique character, its heterogeneity, might be critical for improving our understanding even further, beyond just working capital.
Like those intangibles we mentioned earlier, if we can measure them better.
Right. It certainly gives you a lot to consider when you encounter financial news or analysis. Maybe we should all be a little more skeptical of those overly generalized aggregate views sometimes.
That's a fantastic point to conclude on. Always question the assumptions behind the numbers. And for those of you listening who are keen to dig into the nitty-gritty details, we highly recommend exploring the full research paper by Gonsalves, Zhu, and Zhang. It's a really fascinating and insightful piece of work that genuinely pushes the boundaries of how we understand asset pricing.